Warning: what you're about to see is controversial, and some may find my financial predictions shocking. When I presented my conclusions in a special video report last month, my firm's servers were inundated with record traffic. Some viewers were angry. That's why, before I go any further, I have to warn you. The conclusions I'm about to unveil are far outside the conventional wisdom. Yet, the conventional wisdom is already costing investors, just like you, some serious cash. I urge you to keep an open mind and watch this video through to the end. Challenge every single one of my facts, and you'll find that I'm right about each allegation I make. And then you can decide for yourself. I guarantee you won't be wasting your time. Believe me, I don't want to frighten you. However, I can't just sit back and watch millions of American investors make a dangerous mistake, ignoring a powerful investing trend that will force some high-flying companies into bankruptcy. Even worse, some stocks that have been paying investors steady dividends for years will slash or eliminate their payouts and distributions, threatening the very stable income streams that secure a comfortable retirement for millions of Americans. That's not what I desire for you. You see, over the past 18 months, I've made some bold predictions on many of the web's most popular financial sites, on television, at financial conferences, and on my weekly radio show, Capitalist Times Radio. No one believed me over a year ago when I said it was time to take profits in deepwater contract driller Seadrill due to deteriorating demand and excess rig supply in the deepwater drilling market. Some sneered just a few short weeks ago when I warned Seadrill's dividend wasn't sustainable over the long run and the stock could halve in value. But on the day before Thanksgiving, Seadrill discontinued its dividend, losing 23% in a single trading day. The stock has plummeted 70% since I recommended taking profits more than a year ago. And no one believed me in November when I said the popular fracturing sand companies, including High Crush Partners and US Silica, would be the next casualties in the energy markets. But again, the stocks tumbled more than 30% in less than a month after I issued my warning to sell right away. Last month, when I said Linn Energy would be forced to slash its monthly distributions by 50% or even 60% in 2015, some pundits said I was crazy. They said Linn's oil and natural gas hedges would save the day for the company. Once again, my research proved correct, and the popular high-yield partnership slashed its payout by 57% on January 2nd. Look, popular online broker TD Ameritrade recently released a report on the activity of the firm's 6 million individual investor clients. The report showed that these individual investors were buying energy stocks hand over fist at the end of 2014. The broker's managing director of trading, Nicole Sherrod, noted that individual investors continue to buy on the price dips in energy, and in particular, oil. Humans are hardwired to see falling prices as a bargain, and the temptation to buy the dip is powerful and difficult to resist. Listen, investors who bought tech stocks in December 2000 probably thought they were getting a great bargain, with the Nasdaq Composite already down 55% from its March highs. Yet, the tech wreck was just getting started. The dip buyers watched in amazement as the Nasdaq plummeted another 60% before finally bottoming in October 2002. Do you know how long it took those dip buyers to just break even? Well, let me tell you. An investor who bought the Nasdaq Composite at the end of December 2000 finally recouped all their losses in February 2007. Yep, it took 6 years just to break even on that investment. That's pretty incredible, right? And how about investors who bought financials in March 2008 after the KBW Banking Index was already 40% off its 2007 highs? Many bought the banks and financial groups like mortgage real estate investment trusts for their attractive dividends. Those investors watched the banks plummet another 76% before finally hitting a low in early 2009. Meanwhile, most financials, at least the names that avoided bankruptcy, slashed or eliminated their dividends, wiping out a lucrative income stream for millions of American retirees. The dip buyers and financials are still losing money, nearly 7 years later. I can't stress this enough. Today's energy dip buyers are catching a falling knife and heading straight for financial disaster. Listen, many investors have been trying to call a bottom in energy stocks. They're getting plenty of encouragement from analysts and pundits on financial television and writing for financial newsletters. Remember, these are the same pundits who just 2 months ago were telling investors crude oil prices would bottom out around $70 per barrel. The same analysts were advising you Seadrill was the bargain of the year at around $20 per share, screaming this popular deepwater driller's 20% yield was secure through 2016, just days before it discontinued its payout. Now these same talking heads are telling you energy stocks are the biggest bargain in the stock market and that this is the best opportunity to buy the dip in the group since 2009. However, these advisors are lost. They're telling you to catch a falling knife just before the next wave of this crisis unfolds. Their timing couldn't be worse. And buying this dip in energy will cost investors some serious cash. Like a motorist trying to navigate the streets of Chicago with a map of Manhattan, they're going to be taking a lot of wrong turns over the next few months. Will you act now to protect yourself from this unfolding investment maelstrom? I hope so, and that's why I recorded this video. In just a few moments, I'm going to walk you through a few simple steps you can take to avoid the coming crisis and profit from the powerful trends underway. I'll tell you exactly how you can get your hands on my latest research with absolutely no risk or obligation. Research and conclusions that are just too important for me to hide behind a paywall. My firm has spent several months and hundreds of thousands of dollars digging into the numbers and performing the detailed research necessary to profit from emerging trends. In this video, I'm going to unveil my latest research, including an energy profit roadmap you can use to generate serious cash and reliable income from the megatrends underway in the energy markets today. But I'm getting ahead of myself just a bit. Let me back up and introduce myself and my firm. Hi, my name is Elliot Yu. I'm the co-founder and chief analyst for Energy and Income Advisor, a comprehensive financial research service dedicated to uncovering the best income and growth opportunities in the energy industry. Co-founder Roger Conrad and I are not new to the financial advisory and research business. In fact, we have more than 40 years of combined experience as analysts and editors of some of the largest circulation financial publications in the United States. Our financial advisories have been consistently highly rated by the industry's only independent rating service, the Hulbert Financial Digest. You may also recognize us from our frequent appearances on CNBC, Bloomberg TV, and Canada's Business News Network. We've been quoted in a number of major publications, including Barron's, Forbes, the New York Times, and the Washington Post. We're sought-after speakers at investment conferences around North America. And we currently serve tens of thousands of investors worldwide through our financial research firm, Capitalist Times. I've dedicated my career to analyzing and identifying profitable investment opportunities in the energy sector. The official program of the 2008 G8 Summit held in Hokkaido, Japan, even called me the world's leading energy strategist. I'm not looking to boast or brag. I reference our success and experience analyzing the energy markets because we believe there's a powerful change of trend underway. Simply put, the recent 60% collapse in global oil prices is only the beginning. Geopolitics, economic realities, and fateful decisions taken by the world's largest and most powerful energy firms are set to change world markets with devastating consequences in the very near future. A little over a month ago, I gave a presentation for a small group of energy insiders and VIPs in Houston, Texas, the very heart of the U.S. energy industry. What I said shocked them. In fact, my conclusions were among the most important investment calls of my career. You see, at the time, crude was trading around $66 per barrel, and many analysts were advising investors to buy energy stocks because the group was a great value. I told my audience in Houston oil would touch $40 per barrel in early 2015, and I advised them to use any strength in energy stocks as an opportunity to sell right away. My advice and conclusions were so far out of the mainstream, I decided to do something I'd never done before. You see, I released a video of my presentation on YouTube that quickly attracted thousands of viewers. Many mainstream commentators said my predictions could never come true. Oil could never fall that far because Saudi Arabia and OPEC can't afford oil prices that low. The conventional wisdom spouted by the mainstream media was that investors should follow the 2009 playbook and buy energy stocks ahead of what would surely be a massive recovery. Well, guess what? By early 2015, oil prices were already trading in the mid-40s per barrel, and the S&P 500 Energy Index has fallen yet another 7% since its December 24th close. The truth is, Saudi Arabia can't afford higher oil prices. Does that sound like a paradox? I promise you this. Watch this video through to the end, and you'll understand exactly what I mean and why oil prices are set to drop to $30 per barrel in the first half of this year. I'll explain exactly why Saudi Arabia will not act to stem the decline in crude oil prices in early 2015. You see, I've uncovered the exact roadmap OPEC and the Saudis are watching so closely. While most advisors and pundits will continue to be dumbfounded by the latest decisions out of OPEC, if you follow this simple playbook, you'll know exactly what to do. You have a very short window to prepare for the next chapter of this crisis. However, you must act now because within weeks, the trends I'll reveal in this video will already be underway. You see, as energy firms begin to report their fourth quarter earnings in just a few short weeks, the trends underway will accelerate, and the outlook for investors buying the dip in energy will get much, much worse. Yet, there's a silver lining. While some investors will feel some serious pain in this downturn, a few simple techniques can help you lock in some tasty yields and profit from the coming energy price collapse. If you understand our energy profit roadmap, you'll also be able to take advantage of some unprecedented bargains in the energy space when the timing is ripe. A month ago, I released a video of a presentation I made to a group of energy VIPs and insiders in Houston, Texas. A video where I predicted oil would tumble to $40 per barrel, and that shares of many energy firms would be crushed. The trends I outlined in that video are even more powerful than I imagined, and crude oil is already plummeting to 6-year lows. I've decided to do something else I've never done before. I just recorded a video update for my VIP presentation covering current trends underway in the energy markets and what's coming up next. This video could save you some serious cash over the next 12 months. It may be the most important presentation of my career covering energy markets. I've got to warn you, this video is raw and only lightly edited. My talk was unscripted again. However, I just couldn't delay giving you this crucial information any longer, not to clean up the audio or to make a few charts look prettier. I guarantee I won't waste your time. Listen to this video through to the end. I'll explain exactly why the pundits have been so wrong about oil prices, and you'll see why the advice of some of the most popular energy analysts out there could cost you some serious cash. Don't delay. There's only a short window of time, a brief calm before the storm. You must act now to protect yourself and your portfolio. Please don't risk losing your shirt. Watch my short video presentation and decide for yourself.
Hello, my name is Elliot Yu, and I'm editor of Energy and Income Advisor. Just a few short weeks ago, I was giving a presentation to a group of energy insiders and VIPs in Houston, Texas, And I made a prediction that at that time seemed kind of bold, which was that oil was going to reach $40 a barrel. At that time, oil was trading around $66 a barrel. At the beginning of 2015, it dipped under $50 a barrel for the first time since 2009. And I'm still reading an awful lot of promotions out there from newsletter writers, talking heads and pundits on TV and on financial television who are talking about a bottom in energy stocks and advising people to go out and buy a lot of these energy stocks. Now, back in December when I gave that talk in Houston, I told the listeners there to use any rally in energy as an opportunity to sell out of a lot of these names, in particular to sell out of the upstream names and the services companies. Now, that would include, what I mean by upstream is companies that are actually involved in the exploration and production of crude oil and natural gas, and services companies, big names like Weatherford, Schlumberger, these companies that are involved in selling services to energy firms to help them look for or produce and develop oil fields. So back in December, I was telling people to sell these into a rally, and I'm still reading a lot of commentary out there advising people to buy these same stocks that I'm telling people to sell. And so I wanted to record this today to give you sort of an update on my take on oil, which has actually gotten more bearish over the last month or so. And in fact, I think that today that oil prices in 2015 could get as low as $30 a barrel before we see a bottom in oil. And I think this is far from an opportunity to be buying these upstream names and these services companies. In fact, I think that's advice that's going to cost you an awful lot of money. Now, I think one of the big mistakes that's being made right now is a lot of these pundits and newsletter writers are looking at the 2007 to 2009 financial crisis and bear market period as an analog for this cycle. So back then, we saw oil prices generally rally through the first half of 2008. Then when the credit crunch really got bad in late 2008 and early 2009, oil plummeted from almost $150 a barrel all the way down to the 30s per barrel. And after that, though, energy stocks actually performed very well. We saw was basically a V-shaped bottom. Oil came straight down, and then it went straight back up. So from the end of March of 2009 up through the end of 2009, so really just 3/4 of that year, the S&P 500 Energy Index was up about 33%. And so a lot of pundits out there are talking about a similar thing happening this cycle. The problem is that they're off on what year they're using as an analog for today. They're way off, in fact. I think that the period about 23 years ago is a much more analogous period to what we're seeing today than the 2007 to 2009 time frame. Now, why do I say that? And I'm going to explain this in more depth a little later on in this video with some charts. But really what we're seeing right now is a crisis of supply, not of demand. Now, the 2007 to 2009 cycle was more of a financial and demand crisis for energy than a supply-side crisis. Supplies of oil were very, very tight in the summer of 2008. OPEC, the Organization of Petroleum Exporting Countries, had very limited spare capacity back then, and that's why oil prices were going up through much of 2008. Then, when the credit crunch got worse, you saw demand from countries like China, which is the source of the majority of oil demand growth over the last 10 years, in fact. You saw that really slump, so you saw demand come down, and you also saw just the financial crisis just hit the stock market across the board. The recovery from that was very rapid because once we sort of solved the financial crunch, the immediate financial crisis, the bond markets opened up again, the stock market began to recover. Those stocks, energy stocks as well, recovered very quickly. We also saw at the beginning of 2009 the Chinese government institute a massive stimulus package, which reignited demand, reignited the Chinese economy, and therefore demand for oil. So we saw a very quick sell-off and an equally quick recovery in oil prices. This time around, it's a totally different story. We're not facing a credit crunch right now in the financial markets, especially here in the U.S. In fact, companies are having pretty easy time borrowing money lately. We're not really facing a demand crisis. Yeah, demand hasn't been great from the U.S., but that's not really been the source of most petroleum demand growth over the past few years. It's really been the emerging markets. And demand for oil from China still is pretty robust. It's slowed a little bit, but it's still pretty robust. What we're seeing this time around is a crisis on the supply side of the market. And what I mean by that is a crisis that's been building for a number of years now, which is that oil production from the U.S. And mainly, and Canada to a lesser extent, has been rising very rapidly. Back in 2005, the U.S. produced around 5 million barrels of oil a day. Today, we're producing well over 9 million barrels of oil a day. So big 80% jump in oil production from the U.S., which has resulted in a glut of oil on the global markets. Now, what's been happening is that Saudi Arabia and, to a lesser extent, the rest of OPEC have been artificially propping up the price of oil. And they've been doing this by controlling supply to try to offset the growth in production that we're seeing from North America and from the United States. So they've been artificially inflating price. Now, what a lot of people are out there saying is that when Saudi Arabia made their decision back on Thanksgiving Day with the rest of OPEC again, not to cut production again to artificially prop up the price of oil, when they made that decision back on Thanksgiving Day, there are an awful lot of pundits out there telling you that they can't afford prices to fall too far, right? Because they need $93 a barrel just to balance their internal budget. So therefore, they couldn't possibly afford oil prices down where they are today, under $50 a barrel, for long. But the reality is that they can't afford higher oil prices. Now, the reason I say that, if you go back to 1980 to 1985 period, during that period, OPEC rapidly cut production of oil. They went from 30 million barrels a day of production in 1980 down to about 15 in 1985. So even though that helped prop up the price of oil, their production fell so far. In the case of Saudi Arabia, from high to low, it fell by 70%. There was actually a huge cost of propping up the price of oil, and that cost came in the form of lower output. The Saudis simply can't afford that this time around. And what they began to realize last year was that by artificially propping up the price of oil, by restricting production, they were actually financing the entire shale boom in the United States. You know, developing these fields is very expensive. These companies in the U.S. have had to borrow an awful lot of money to develop fields like the Bakken Shale of North Dakota, like the Eagle Ford Shale of southern Texas. And this was all financed indirectly by higher oil prices. So what the Saudis decided at the end of 2014 was to let the free market reign. And when the free market reigns and artificial prices are no longer maintained, you saw prices fall. And what that's doing is it's sowing the seeds of its own recovery. Because over time, lower investment in oil production will occur because these companies can't afford at $40 or $50 oil what they could afford at $100 oil in terms of drilling activity. So over time, this will happen. The problem is it takes a lot longer for supply to adjust than a lot of people are seeming to suggest. So this isn't going to be a recovery that's going to happen between now and next summer. This is a recovery that's going to take at least a year to fully unravel. And so I think a better year to look at is actually that 1985-1986 period. Now on this first chart that I'm going to throw up here, this is actually an interesting chart, I think, and I look at two different time periods. The blue line on this chart is actually the period starting in March of 1985, and this is just oil prices, the price of West Texas Intermediate or WTI crude oil. And so what this chart looks at is the blue line is the price of oil, the nominal price of oil, not inflation adjusted, from March 1985 for 200 weeks, which is just under 4 years. The orange colored line on this chart is actually the period starting in January 2014. And again, it's the price of WTI crude oil. Now, because the nominal price of WTI crude oil in 1985 and today are very different, I normalized them so that we both start at 100. So in other words, this chart starts at 0%, and I'm showing the percentage change over this time period. Now, if you compare these two lines, they're very, very, very similar. For the first few months, or the first 6 months or so on both of these charts, you see the price of oil rise. Now, in January 2014, between January 2014 and June of 2014, we saw oil prices up about 15 or 16%. In the period from March 1985 up until about September, October of 1985, we saw oil prices rise almost by the exact same amount. Now, a lot of that was due to talk of surely OPEC is going to cut production once again. Back in 1985, it was being said, and it was being said again in the first half of this year, surely OPEC is going to cut production to offset all this growth we're seeing in supply from non-OPEC countries. When they didn't do that, and the market started to price that in, oil prices began to plummet. And sure enough, you see that back in March of 1985. So from the beginning of March 1985, up for about a year, and you look forward about a year in the future to March 1986, oil prices were down about 66% over that time period. Right now, if you look at the orange line on my chart, oil prices are only down about 55% over an equivalent time period. And I think we're going to actually see oil prices follow very much the same pattern going forward as to what happened back in the late 1980s. Now, if you look at the blue line on the chart, oil prices bottomed out, again, down about 65% from the beginning of March of 1985. They bottomed out in March, April of 1986, and they kind of bounced around that level. Now, we definitely saw some rallies in oil over that time period, some short covering rallies, a little profit taking from people who were right about oil. We saw oil bounce around in that level, but oil prices did not have a V-shaped recovery. In fact, if you look forward about 4 years on this chart, you'll see that oil prices only recovered a small portion of those losses. They were still down about 40% plus from their March 1985 highs. So if you look at that, oil prices are following very much the same pattern, and I think that's going to continue going forward. So the key thing to understand here is that the 2007 to 2009 period is not a good analogy for what's happening in the oil market right now. The 1985 to 1990 period is a much better analog for what's going on right now. And if that relationship continues to hold, as it has almost perfectly on my chart here, then what you're going to see is oil prices get down to that $30 to $40 a barrel region, probably in the first part of this year. And then you're going to see oil prices bounce around between sort of that $40 or $50 region all the way up to maybe $60, $65. But you're not going to see that V-shaped recovery in oil prices back up to $80 or $90 or $100 a barrel, which is what a lot of pundits are out there predicting and using that as a rationale for buying a lot of these energy companies on the dip. Now, if you agree with my analog year, 1985 to 1990, then these energy companies don't look cheap at all. Now, a lot of people are out there saying, yeah, if oil prices go back to 100, a lot of these energy oil services companies, upstream names, are cheap at current valuations. But if you believe that what I'm telling you, that the analog year is more like 1985 to 1990, which is more consistent fundamentally as well, then these energy companies actually look to be one of the most expensive sectors in the S&P 500 and should be avoided. Now, that doesn't mean you can't make money. There are plenty of sectors that do very, very well when oil prices are down. A lot of them are in the consumer goods area. Companies that are involved in selling products to consumers do well because consumers have more money in their pocket when energy costs go down. For lower income families, for example, in the U.S., over the last few years, they've been spending an average of 20% of their after-tax income on energy. And with energy prices going down more than halving from where they were even a year ago, those families have a lot more money in their pocket to go out and spend. So similar to what we saw in the late 1980s, I think that the consumer stocks in the U.S. are going to see a real renaissance over the next year or two as all this money flows into their pockets from lower energy bills, just like we saw in the late 1980s. So it's not that you can't make money, it's that you can't make money by buying the dip in a lot of these upstream and commodity leverage names in the energy patch. Now, as I mentioned, I believe that the Saudis can't afford higher oil prices, because if the Saudis were to restrict production and push up the price of oil, then you would actually see that help to underwrite further gains in U.S. production growth. So we'd see non-OPEC production ramp up again, and that would actually exacerbate the glut in global oil markets that we see today, which is around 2 or 3 million barrels a day of excess oil being dumped onto the global market. Now, one of the other arguments that I'm hearing a lot on the financial news and from other newsletter writers is that what we're going to see is a very quick production response in the U.S. Now, the idea here is that a lot of these companies, names like Continental Resources, EOG Resources, these companies are actually producing from fields like the Bakken Shale of North Dakota, the Eagle Ford Shale of southern Texas, that have high decline rates. Now, what that means is that production drops off rapidly from when you first drill a well to, say, a year or 2 or 3 down the road. With oil prices way down and around or even below their break-even points, the idea is that they're going to slow down their drilling a lot, and that very quickly the decline in those older wells is going to result in a decline in overall U.S. production. And to further that, they have a limited number of hedges in place. Now, these are futures and options and swaps that they've used to lock in higher oil prices. They took a lot of these hedges out, say, a year ago when prices were much higher, but those are going to start to run out by the middle of 2015. And when those hedges run out, the conventional wisdom says they'll have to cut back on drilling even more, and production will very quickly fall, rebalance the global oil market, and we'll see oil prices go back up. Now, here's why that's wrong. For one thing, we saw this exact same scenario in the U.S. natural gas market just a few years ago, back in 2009, 2010. The idea was that drilling activity slowed way down, and therefore production would surely soon follow. It didn't. What ended up happening was that the producers actually just focused the fewer rigs that they were running on the most prolific, high-return plays they have. So instead of just drilling wells everywhere, they focused their attention on the most profitable, lowest cost plays around. And so what that meant is that they focused their attention on plays like the Marcellus Shale in Appalachia, that you can produce gas profitably even at much lower prices. What ended up happening was that they saw such great gains in efficiency. In other words, the number of wells they could drill in a given period of time, in say a month, shot up dramatically because they started adopting new technology, more powerful rigs, pad-based drilling technologies where instead of moving a rig physically around using a truck, you simply are able to move a rig across a small pad and drill many, many wells. Greatly speeds up the amount of, in other words, instead of taking 30 or 40 days to drill a single well, they can do many, many, many wells in a given month. So by adopting these technologies, they were actually able to become much more efficient and produce a lot more natural gas with a lot fewer rigs. The same thing is actually happening right now in the oil market. What you're seeing is that, yes, EOG and Continental are laying off rigs. They're using fewer rigs. They're reducing the U.S. rig count. They're drilling less. But they're refocusing those rigs that they do have on their most efficient, most productive, and lowest cost plays. And that's going to keep oil prices okay, the oil production rising or at least flattish for a period of time forward. We're also not yet seeing the kind of CapEx cuts, the kind of capital spending cuts that we need to see to actually see a decline in oil production. What we're seeing is they're cutting CapEx to keep oil production flat. That's not enough to balance the global oil market. I think we need to see an actual decline in U.S. production, not just a flattening off of production. So what we see is that Saudi Arabia can't really afford higher oil prices. Higher oil prices encourage your non-OPEC producers, your companies in the U.S. that are producing out of shale plays like the Bakken Shale, North Dakota, to accelerate their drilling plans. And so what we really need to see is oil prices come down, way down, far enough that these companies slow down their drilling activity enough to actually reduce overall U.S. production. Now the problem with that is it does take some time for that to happen. It takes time for drillers to change their plans. A lot of them have already contracted rigs for 2 or 3 years in the future, which means that unless oil prices get down so far that they're actually negative in terms losing money on an operating basis, they're probably going to continue to drill pretty aggressively, and production is going to continue to grow. And we're not yet seeing the kind of capital spending reduction that we need to see from a lot of the big shale producers, companies like EOG Resources or Continental. We're not seeing enough of a capital spending decrease to actually bring down their production. Really what they're doing is they're concentrating their attention on the most profitable plays that they have. So instead of drilling on the marginal edges of the Bakken Shale, they're concentrating their rigs on the most efficient, cheapest to produce parts of the play. And what that's going to result in is maybe flat production or slight growth in production versus, say, 20 or 30% annualized growth in production. But that's not enough to rebalance the global oil market, which is still 2, maybe 3 million barrels a day oversupplied. The other problem that I'm seeing, and there was a very interesting article in the Wall Street Journal right at the beginning of January 2015 about this, is we're beginning to see a lot of the big producers out there, companies like EOG and Continental, they appear to be resetting their hedges. Now what that means is a lot of these companies had previously hedged their their production at $90 or $100 a barrel oil. So they bought put options, or they'd use swaps or futures to hedge their production at, say, $90 or $100 a barrel crude. Now with oil down in the 60s or 50s, or really dipping into the upper 40s in the beginning of January, they're obviously making a lot of money on those hedges. They're worth a lot because they allow them to sell oil at much higher prices. But what we appear to be seeing is companies like EOG are actually resetting those hedges. And what that means is they're selling those swaps back to their dealers, they're selling options, and they're taking a profit on those hedges, and then they're buying new hedges at much lower prices. Now what this allows them to do is actually hedge a larger portion of their production than they had previously hedged. Granted, at much lower prices, but still at price levels we believe that are going to allow them to make money. So what it appears is actually happening is that even though oil prices are falling, a lot of the producers aren't really responding in terms of reducing their activity so much as they are hunkering down to continue to be able to make money over the next year or so. So what that means, I think it's actually take a little longer for oil production to respond to these lower prices than many people think. And I do have this chart here showing about the best proxy we have for hedging activity among the producers, which is to look at the Commitment of Traders report from the CFTC and look at how much producers are short oil futures. And if you look at this, back in August they were short about 16,000 of these futures and options, and now it's down up over 80,000. So they've been really increasing their net short position in terms of total contracts in the futures market, which suggests that they've been hedging very aggressively as oil's coming down. And that's the kind of activity that means that they're actually trying to protect their margins in 2015 so that they can last a little longer, so that they can withstand lower oil prices without reducing their drilling activity. So I think this is actually going to mean that it takes a little bit longer than many people expect for oil production to come down and for prices to begin to recover. So the last chart I have today is actually just a long-term chart of oil, spot crude oil. And what you can see is that, obviously oil prices have fallen very rapidly to the upper 40s here in early 2015. A month ago, when I was speaking to that group of VIP energy insiders in Houston, Texas, I predicted $40 a barrel oil. I actually think we may go back down and retest those 2009 lows for oil, which are about $30.50 a barrel. So I think that's how low we're going to have to get to be so low that producers actually start to respond in terms of cutting supply, cutting production, cutting drilling activity enough to actually rebalance the global oil market. Now, the Saudis can afford this for a period of time. Many of their wells are still cash flow positive, even at $15 or $20 a barrel. They're fine at $30 a barrel. Yes, they're not able to cover their government spending, their national budgets at $30 or $40 a barrel oil, but they have enough cash reserves to cover themselves for a year or two of lower oil prices without having to really cut the social spending that they're making internally to keep their populations from revolting. So I think we can continue to see lower oil prices for a lot longer than the market currently expects, and that's really bad news for energy stocks and oil prices, especially over the next 6 months or so. It is not the time to go out and aggressively buy these names. There are plays in the energy market that make an awful lot of sense right now, and a lot of them are in the downstream or midstream segments of the energy business. These are companies that are transporting oil and natural gas around, or companies that actually use oil and gas, companies like the refining sector. So there are plays in energy. They're just not in these upstream and services names that I'm hearing an awful lot of people trying to call a bottom in, and I think that bottom may be a lot lower than most people expect, especially if I'm right and we do get down in the 30s on oil in 2015.
I know many of my peers are in serious denial about the potential downside in energy prices. They're still advising investors to buy energy producers on the dip and hold on for a rally in oil prices by next summer. They're hoping for a rally back to $100 per barrel by the end of 2015. They're projecting a repeat of the 2009 V-shaped bottom in oil and energy stocks. However, hope is not an investment strategy, and they're following the wrong roadmap. This is a crisis of supply, not demand, and oil will follow the same pattern as the late 1980s. Some predict the Saudis will soon slash production in an effort to buoy prices. However, my firm's research confirms the Saudis can't afford to cut output. They can't afford a repeat of the OPEC market share collapse of the early 1980s. Instead, they want oil prices to fall in the short term, and fall they will. Yes, oil prices have already fallen pretty far and could be due for a short-term bounce. An oversold bounce could take crude higher over the next few weeks. However, that move is just the calm before the storm. Oil is headed to $30 per barrel or even lower by this summer. Do you think I'm exaggerating? Just remember, no one expected shares of Seadrill to fall more than 70% from their highs, or the formerly red-hot fracturing sand producers to give up years of gains in just a few short weeks last fall. But these former high flyers were crushed, and Seadrill's dividend eliminated. And many people laughed when I predicted crude oil prices would fall from near $70 in November to $40 per barrel in early 2015. However, crude fell even faster than I projected, and several high-yield energy stocks have been forced to slash their payouts. There's more pain ahead for investors who don't follow our energy profit roadmap. Let me ask you a question. Will you act now to protect your portfolio? I hope so, and that's why I recorded this video. So what can you do? Well, I've done a lot of research on this, and I've found that there are a surprising number of simple things you can do to not only protect what you've currently got, but also to potentially make quite a bit of money as oil prices fall this year. Here are 5 simple steps I'm recommending. Profit step number 1, hedging your bets. What if I told you that one stock we recommend as a play on falling oil prices has soared 60% since mid-October alone? Would you be interested in hearing more about that kind of opportunity? Let's be honest. While the sector has performed well in recent years, energy stocks still account for less than 10% of the S&P 500. Many of the remaining 90% of stocks and sectors benefit from lower oil prices. However, a small handful of names are getting a game-changing boost from lower oil prices. The sort of tailwind that's already powered gains of 100% or more from some of our top hedge recommendations. I don't have time to go through all the details of our top plays on lower oil prices in this short video. However, I will explain everything in full detail in my new report called Hedging Your Bets: Stocks That Thrive When Oil Dives. And I'll gladly give you access to a copy absolutely risk-free. And I'll show you how to get this valuable research report risk-free in just a second. Profit step number 2, pull these babies from the bathwater. How about the names of a handful of tax-advantaged, high-yield stocks that have been caught up in the energy price panic? A classic example of Wall Street throwing the babies out with the bathwater. These stocks are down for no good reason, offering investors the opportunity to lock in high, fast-growing yields by purchasing these stocks at discounted prices. I'm talking about yields of 4%, 5%, and even over 7% from rock-solid income gushers, with the potential to generate significant income growth over the next 3 years, regardless of where oil is trading. In our hot-off-the-press special report called Game Plan for Lower Oil Prices, Pull These Babies from the Bathwater, we'll unveil all of the details of 5 of our top picks to buy right now at fire sale prices. Plus, I'd like to send you information on a secret high-yield asset class few are talking about. An asset offering yields of 13% or higher that can actually benefit when some energy stocks are forced to cut their dividends and distributions. Profit step number 3, profiting from the pain and collect a 13% yield. I've got to warn you, some pundits are actually telling investors to avoid this asset right now. Yet these securities offered huge returns the last time energy prices fell in 2008 and 2009. We expect total returns of 50% or more over the next 12 to 18 months. This opportunity is a little unconventional, but has been a favorite of wealthier investors for decades. I'd like to give you access to this third valuable report detailing this secret asset class and strategy, also absolutely risk-free. I'll show you how to get it in a second. And what about preserving your wealth? You must avoid the energy stocks that are getting crushed in this bear market. I'm talking about companies like Seadrill, Hi-Crush, and Lin Energy that could decline 80% or more from their recent highs. Let me ask you a simple question. Have you ever stayed awake at night thinking about the security of your portfolio and the safety of your dividends? Profit step number 4, the energy market's ticking time bomb. In our 4th special report, we'll unveil 3 popular stocks that are extremely dangerous investments. 2 of these dangerous stocks are high-yield securities popular with safety-conscious income investors. You need to sell the 3 wealth-robbing names in this just-released special report right away. And that brings me to our 5th and final special report. Profit step number 5, a certain winner in uncertain times, our favorite new MLP. Master Limited Partnerships, or MLPs, are a group of tax-advantaged, high-yield investments that have blown the S&P 500 out of the water over the past decade. Over the past 10 years, the industry benchmark Alerian MLP Index has soared 300%, compared to a gain of less than 118% for the S&P 500. However, we've identified one simple characteristic you can use to identify the top-performing MLPs. One MLP with this simple trait soared 1,160% over the past decade alone. That's enough to turn a $10,000 investment into nearly $120,000. Another MLP we identified with this same golden characteristic has jumped over 150% since going public just over 2 years ago. That's close to 5 times the return for the S&P 500 over the same time frame. You'll be shocked at how well this one simple trick for identifying the top-performing MLPs works. And we've included all the details of this strategy and one of our top MLPs to buy right now in our special report, available risk-free for a limited time. Please, just give the work I've done a look. Read my 5 special reports, and I believe you will have all the information you need at your disposal. The best part is you can take a look at my research and receive everything I've mentioned here at absolutely no risk or obligation. Simply let me know you'd like to take a trial subscription to our service, Energy and Income Advisor, and I will immediately give you access to all 5 of our newly released research reports. Click the green Subscribe Now button below this video and test our service for 30 days. Download all 5 of our special reports. Read 2 detailed monthly issues of Energy and Income Advisor. Gain exclusive access to our model portfolios offering suggested allocations for growth, income, aggressive, and conservative investors. Read through our extensive archives. Now let me ask you a simple question. Wouldn't it be great to be able to pose any question you like about the stock market, economy, or individual stocks and bonds and have your questions answered? Let me tell you about our monthly web chats, a feature of our service Roger and I pioneered a decade ago. It's still the most popular feature of the Energy and Income Advisor service. These chats are an opportunity for you to ask us any question you wish about stocks, our recommendations, the economy, or the broader market. Ask any question you like, and we'll answer every question we're asked on the chat. Last month, we were online for more than 7 hours, answering questions posed by subscribers. Our next scheduled online chat is coming up in just a few weeks. Just enough time for you to read our research and prepare any questions you might have. Click the green Subscribe Now button below this video. Sign up for a risk-free trial subscription to Energy and Income Advisor, and we'll rush you the details of how to log on to our exclusive subscriber-only online chat. We believe there's no better service on the market today, and all we're asking is that you give us a fair try and see for yourself. If you don't believe it's worth every dime of the subscription price, cancel in the first 30 days to receive a full refund, no questions asked. And for viewers today, we're offering Energy and Income Advisor at our special introductory price. What have you got to lose? Test our service for 30 days. read our research, and join our monthly web chat. Then decide. If Energy and Income Advisor isn't for you, cancel in the first 30 days. Keep your 5 free reports, and I'll refund your full subscription price, no questions asked. Here's to your wealth. To start your risk-free trial, please click the subscribe now button below this video and join us today.